Jigar Mistry, the co-founder of Buoyant Capital, joins in now. Jigar, always a pleasure to welcome you on NDTV Profit. What do you make of the market with volatility and tight range and somewhat directionless today?
Good afternoon, Nisha. Pleasure as always. Thank you for inviting me to your show. So I would think, see, at the start of at the start of the month and the last week of January, you saw a lot of actions, right? You had the trade deal sign in, the budgets, and now I think the market has absorbed a lot of that and is trying to figure out how the earnings are panning out. And I think it will take a little bit of a time till the time normalcy returns, but interesting times nonetheless, Nisha.
That's right. In fact, Jigar, a lot of factors are really impacting the overall market momentum. Earnings is one and global trends are another. And the AI aspect has also added to the worries and uncertainty going forward. How do you read into the top 5, 6 IT companies of India? And with the AI pressure mounting, would you be an investor at this point when they are beaten down? And what's your outlook for this space?
Right, Nisha. So getting into it, we had a very minuscule, if not zero, exposure to a lot of these big bang IT names. And the argument was simple that obviously nobody really knows how this plays out. But incrementally, we have seen, how machine learning and artificial intelligence is helping our business do better with a fewer number of people. And if that were to become a reality across the BFSI verticals, and I completely understand, you have like an archaic back end and a very flashy top end, and what IT is involved with is pretty much, filling the gap in between doing daily reconciliations. And therefore, it's not really something which will be able to get replicated easily. But necessarily, you will have a situation where if fewer number of people are required, then clearly, you're accounting for lower growth in the explicit period forecast. And the big question is, what terminal value are you okay to work with? If you are saying that 4 to 5% number is closer to zero now, then you are essentially valuing these companies at dividend yields, which means lower P multiples even from here. So no, we are not really in a big hurry to dial up exposure here just yet.
All right, a lot more needs to be understood about the IT sector before jumping into the current momentum. But Jigar, at this point, the broader market, they were overvalued as most of the experts had been pointing out. With the recent weakness in the market that we have seen, do you think that there are pockets which are looking mouth-watering to invest at this particular time for long term?
Yes, Nisha. So, see, the structure has changed a little bit. What was troubling India was, I would say, three or four branched issues. With the trade deal getting done, I think it does a lot more for FX than it does for GDP. That's point A. Point B, budget is out of the way now. So, we have a firm bit of clarity that numbers will hold. We took away from that to mean that you might not see a lot of rate cuts, but the street is still expecting maybe one or two rate cuts. So, but that became a lot more clear as well. Incrementally, I think it will now depend on the quarterly earnings. Now, in the process, please do remember that 81% of demat accounts open today have come post COVID. They've seen extremely strong returns in both Nifty and more so in small cap space. And you could show a lot of data arguing that a 10-year rolling return on say a large cap or a small cap index is only 13 or 14%, but their experience was 25 to 35%. So it was directly colliding. Most portfolios were not geared up to deliver a 15, 16% return. They were still aiming for very strong returns. And when sort of the reality hit them in terms of earnings not flowing through, many of them are now amenable to, long-term EPS share price growth must always align argument. So I think if the portfolios are structured in that fashion, I would believe things would be better. And from that construct standpoint, we are hopeful about a lot of sectors. Notably, the money that's been given in the hands of people will get saved and lent, and therefore lending institutions, both banks and BFCs are of interest. Secondly, consumption can make a comeback, right? Post COVID, you've seen most of these stocks flatline for almost 5 or 6 years, and you would see them come back. It started with discretionary. We think it will spill into into staples as well of all sorts, and that's an area of interest. And besides this, I think pharmaceuticals, not hospitals, pharmaceuticals is something that is of interest to us as well.
All
Nisha.
right, so these are, Jigar, the trends that you're looking at. What could be the no-go areas at this point, or some concerns building besides the IT sector, which is on wait and watch mode?
That's one clear point, Nisha. The second point is that a lot of these companies which drove the market momentum post-COVID until September 24, namely the capex heavy railway defense, whereas spends will likely continue here, but the stocks are discounting a lot more than what can actually be delivered. So that's one space that we are staying away from: railway defense, capex, and IT largely.
All right, Jigar, thank you so much for getting your insights on the market momentum as well as the investment strategy. Thank you. Always a pleasure to welcome you on NDTV Profit.
My pleasure, Nisha. Thank you.